Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we share with you all the latest updates of the stock markets and the closing action of the trade as well. Well, so far throughout the trading session, it's been a choppy trade that we've witnessed and the markets have been largely lackluster. Look at the current levels as well. You'll find that there's just a minor loss of about 15 odd points on the Sensex. 60,102, 17,894 for the Nifty right now, down about 20 odd points, absolutely flat with a negative bias. Look at the other sectors as well. The broader markets also showing some kind of mixed trend with 0.25% decline on the mid-cap 100 index, whereas the small caps are managing to just float ahead or above that flat line too. Talk about the other sectors of the Nifty. You will be able to see there's a mixed action right there with largely sectors pulling up into the green. Led by gains in the banking space. We are seeing the Nifty Bank up by 0.5%, financial services up 0.5% as well. All the components, in fact, up in the green. The IT stocks are moving too on the upside, about 0.5% gains right here. Metals are shining bright with 0.9% gains. Realty flat with a positive bias right there. The auto space, however, is sulking today amidst the auto show that's been going on. No spark right here on the auto space, 0.6% of a cut for that one. The FMCG index is leading the losses today with over 1.61% kind of a cut, and the pharma stocks are dragging too with 0.6% of a fall too. In terms of the advanced decline ratio, you will be able to see that 30 stocks of the Nifty are in fact seen on the declining trend, whereas just about 19 stocks are up into the green. The stocks that are actually dragging the most include the names such as Bharti Airtel, Cipla, Divis Laboratories, Apollo Hospitals, Hindustan Unilever. So large part of that chunk on the lower side is from the pharma pack, and some of these FMCG majors and individual companies with news flows too. On the upside, you have Hindalco, BPCL, Sun Pharma, Ultratech Cement and HDFC Bank as the top movers at this point in time. But what are the experts really making of the kind of move that we've been seeing on the markets? Let's find out from our expert who's joining in right here. Amit Khurana joins in. He's the head of equity research at Dolat Capital. Welcome, Amit, and thank you so much for taking the time out for this discussion. And here's wishing you a happy new year. Help me understand, your thoughts. We've seen about 7-8 sessions already. It's been a turbulent start to 2023. Is that an indication of sorts as to how do we expect the markets to go this year?
That's a very fair point, Sakshi, and thank you for inviting me, and Happy New Year to you all and all the viewers. Our base case when we started into 2023 calendar year was that the first half will probably go into a directionless, very indecisive market situation, and there are a few valid reasons that we believe are leading us to that assumption. One, there's a very clear-cut feeling that 2023 will see a global recession and India will also see some slowdown in growth. Now, to what extent will that percolate? How severe or how shallow? I think that's one question which the markets are trying to figure out.
Sure.
The second core issue obviously remains as to, in that environment, how do the earnings behave on some of the global sectors like IT services, metals, exports at large for India, and as also their ripple effect on the domestic consumption, the consumer sentiment, demand for discretionary products, and a whole lot of other categories.
Okay.
Will the earnings take a bigger cut or a very minor cut? I think that's the other measure which the market is looking for. So in that situation, I guess this yo-yo kind of a situation can run through the earnings season and possibly even through the first quarter. And hopefully we should get some clarity and some meaningful directions as we get into the later part of the first quarter and early second quarter of the calendar year.
Okay, but what is the apt strategy that you would advise investors to really adopt in this year, which is full of, again, macroeconomic uncertainties? We do not know. We are yet awaiting the clarity on a lot of fronts, including the slowdown that you pointed out, the direction that the Fed really takes on the interest rate fronts as well, and the domestic cues from the earnings that we are getting. We're off to a decent start, but largely modest start. It's not a good start to the earnings that we have seen so far as far as the TCS numbers go. But overall, keeping all these factors in mind, the way that investors should really approach their own portfolio and the markets.
Sure. So we put out a note saying that the next couple of quarters should be more bottoms-up stock-specific names. Nifty as an index or the other indices should not be the benchmark to set your return expectations. And there we are right now backing domestic consumption-oriented themes, staples as well as discretionary, and also a bit of defensive flavor to it, which includes staples as well as pharma. There is also, a liking that we have for some of the other discretionary categories, which includes real estate. We believe that the cycle is extremely robust and constructive for India, and some of these sectors will, some of these players will do pretty well. So bottoms-up names with a flavor of defensive, and banks, of course, which is probably the best shape that we have seen over a long period of time, remains the core part of our holding. I think it's also important for one to be very sure of what to avoid at this stage, because you don't want a very high beta portfolio. So avoid the high beta names at this stage, very risky names. So that we are very clearly avoiding for the first half.
Okay. Do you also think that the sectors that worked well in 2022 and vis-a-vis the sectors that did not perform, the same trend may continue in 2023, or is that going to be a change?
Very difficult to say that. The reason I say that, because it's, again, as I said, it feeds into my core argument that bottoms-up stories are more relevant, and if they happen to be from the same sectors which did last year, so be it. For example, banks, I said, they outperformed by a wide margin in the second half of last year. I would suspect, I would believe that they will continue to outperform through the year. But you did see IT services underperforming, and I would not be surprised if they underperform again for first half of the year. So it's a very, very bottoms-up market, very, very stock-specific, strategies that one will have to adopt, and therefore I would not be surprised if the outperformers continue to outperform again.
Okay, okay, noted that. Also, when we've been speaking about earnings too, what do you make of the TCS numbers, and is that an indication of how the entire sector may actually come out with the earnings? And overall also for the entire Q3 earnings season, what are your key expectations? Some of the sectors that may actually come out with better earnings?
Well, quick word on TCS, largely in line, hasn't changed our big picture opinion on the stock or on the sector, so to say. I think the high single-digit growth estimates stay intact. The big evidence we will look out for, based on lead data from the US and other global macroeconomic area, is if it deteriorates significantly to lead this to a likely a zero growth or a 2-3% growth. That's the big picture I think which will emerge and drive the valuation for next year. So I think largely stays intact, no change on our view, so to say.
Okay, okay. And what are your expectations? We're just weeks away from the budget 2023-24. Your big expectations here, and which sectors do you believe can actually be in the spotlight amidst the budget discussions before, and this is going to be the last budget before India goes to polls in 2024. Any indications of more populism coming in some of the sectors that may actually get a lot of focus in the budget speech?
Well, I haven't come across any significant expectations or any significant concerns till date. I think there are a couple of very fundamental reasons. I think the GST collections are pretty strong, and that gives a lot of confidence to the markets at large that you will not see a very significant deviation on the projected numbers versus the actuals which might get reported on the budget.
Right.
And the second part is, I think budget overall as an exercise has become very irrelevant, because most of the policy parameters are very well known. They are very predictable. And with GST as the core of your tax collections, this whole issue of, uncertainty has really got taken out of the equation. True. And you don't have much tweaking around on the customs or the excise left to do. So my best case scenario is budget doesn't do any damage to what is already a pretty stable, environment. Of course, there are gray areas which will have to be addressed, and one is hoping they will be. And, as it is said, don't touch if it is not broken. I guess that is the stage we are at. So budget should not have any, very unexpected negative overhang on the market. Other than that, I don't think I have any positive or any negative expectations out of it.
Okay, okay, all right. Noted that. Speaking of interest rates, we have seen that we've been in a larger interest rate up cycle. We do not know as of yet how long will this continue, although most analysts have pointed out that perhaps there could be just one last more, rate hike by the RBI. The US Fed continues to be aggressive on taming inflation. But do you see interest rates peaking out in 2023? And if yes, then what kind of an impact could we actually see on both currency and the equity markets?
Well, I'm in the camp which believes we are at the fag end of the rate hike cycle by the MPC here in India, and largely even at the global end. While global end may continue a little longer, but I very clearly believe that RBI will probably give a lead signal in the February policy itself. Whether it is the last hike by the MPC here or not, I would probably put it at 70-80% probability. But I think the market is looking for the very clear confirmation that we are at the fag end of it. A likely confirmation in the market confidence can lead to a pretty significant re-rating for some of the stocks sectors which got impacted because of rate hike cycle. I mean, primarily real estate was one. While the ground level data is extremely robust and probably the strongest we've seen in years, but the stocks have relatively not been performing because of the overhang that the market feels that the buyers will probably be delaying their decisions. So that could be one sector which will benefit. And then you have the large manufacturing sector, some of the other, cement could be a big beneficiary of that. And so will be the other sectors at large, which could possibly have a positive rub-off effect on the market.
Okay. If I were to ask you that for, the first-time investors, all of those new investors who entered the fray in the last 2 to 3 years, at the starting of 2023, if they're looking at their portfolio from a rebalancing point of view or from, new additions point of view, how would you really advise them to really create this portfolio in terms of the stock selection? How should they go about it? What kind of stocks will do better in 2023?
Well, very difficult for me to put it in a few sentences. There's so many things that one has got to look at when you're allocating money. So I would probably put it in more generic sense. You've got to really look at your portfolio allocation in three broad buckets.
Okay.
One, something which you can hold for longer than 3-4 odd years, and that has to be a little lower risk part of your portfolio. Second has to be more medium-term objective where you are looking to generate a little bit of an alpha. And then you can probably even raise a bit of a risk. And third bucket, which I'm probably not the right person to talk, is an extremely tactical way of managing your portfolio, which is more event and momentum-based trading strategies. You've got to talk to your advisor and take adequate, input from those experts. But broadly, if I were to look at investors have to take a look at the next 3 to 5 years, India will grow as an outperformer versus the other peers. We as an economy are at a very, very important inflection point, which will raise the share of manufacturing in our overall GDP. Efficiencies because of GST now getting streamlined are getting reflected in the tax collections, and that is enabling the government to spend more and more on infra, which is also going to raise productivity for large set of sectors and companies operating therein. So there is a structural equity play in India, and therefore, rather than taking a day-to-day, month-to-month view on the markets and the stocks that you're investing in, take a longer-term view of at least 3 to 5 years. Invest in good quality managements. Take a look at their past track record in terms of their behavior as a promoter, and then allocate your risk capital to those models, and eventually they will tend to outperform over a period of time. And have realistic expectations. I mean, you cannot double your money every year. There will be phases when you will obviously have an underperformance. I mean, for example, small caps actually did very badly last year.
Yeah.
Now, some of the companies are extremely robust and very strong business models. Eventually, they will make a comeback.
Okay. This year, do you think small caps could make a comeback?
Absolutely. If the rate cycle tops out and raw material inflation tops out, small caps will be the biggest beneficiary.
Okay, noted that. Well, on that note, thank you so much, Amit, for being with us and sharing all these wonderful insights from various sectors and the pockets that we've spoken about on the markets, and helping all our viewers really understand the way, the right approach to the markets at this point in time too. Many thanks for joining in. Let's look at how the markets are really closing in. We're just 10 minutes, 11 minutes away from the close right here. 60,056 for the Sensex, down by 60 odd points, 30 points of a cut for the Nifty 50. Right now it's below that 17,900 mark, but we'll have to wait and watch whether that mark really comes back on the screen as we close down another day of losses, the second consecutive day of losses on the D Street too. But keep you posted with everything that's buzzing on the D Street, so don't go anywhere. Stay tuned with us onto Business Today TV. Don't forget to subscribe to this channel and also stick with us and engage with us constantly through our other social media platforms, Facebook, Twitter, LinkedIn and Instagram. Many thanks.